Right now, retail portfolios are deeply concentrated in a handful of U.S. tech giants. It's a textbook case of what Germans call Klumpenrisiko, cluster risk. To escape that trap, investors naturally look for lifeboats overseas. The obvious targets are major developed markets with strong industrial bases: Germany, Japan, and Switzerland. This chart shows the scale of the valuation gap. While the S&P 500 currently trades at a forward PE ratio of almost 29, the DAX, Nikkei, and SMI are priced at roughly half that level. But grabbing a broad ETF that tracks these cheaper foreign indices introduces a new problem. By doing so, you trade one obvious concentration risk in the US for a set of hidden structural flaws built directly into the indices themselves. To use these markets effectively, we have to look at the structural friction within each one. Your ability to navigate that friction determines which market actually fits your execution capacity. True diversification requires looking past the country name and assessing the gap between a nation's actual economic engine and the index you use to access it. Switzerland is heavily relied upon as an income fortress. It offers unmatched political stability and an independent currency that tends to appreciate against its peers. For dividend investors, the pitch is compelling. Beyond the top tier, the second and third rows of the Swiss economy are packed with highly profitable niche champions committed to consistent shareholder returns. The trap for passive investors: buying the standard Swiss market index means three legacy companies consume most of the weight. Nestlé, Roche, and Novartis squeeze out innovative midcaps, turning a broad geographic ETF into a concentrated sector bet. This is a reflection of physical reality. These megacaps are deeply entrenched giants that completely overshadow the rest of the Swiss exchange. Buying a standard market cap Swiss ETF fails the test of true diversification. You're taking a concentrated, defensive position in legacy food and pharmaceutical monopolies. In Japan, the macro catalyst is structural reform. After decades of economic stagnation, the country is escaping deflation and actively forcing its corporations to unlock massive cash reserves to create value for shareholders. Japan's demographic crisis acts as an economic engine. A shrinking workforce mandates the heavy adoption of industrial AI and advanced robotics on the factory floor. This environment exposes a specific type of value: high-quality mid-cap companies with zero Western analyst coverage, many of which trade below their book value. But capturing that value means fighting severe friction. You face language barriers, lack of retail data, and opaque conglomerate structures holding complex, interlocking ownership stakes. Japan is a goldmine for the high-capacity, active stock picker willing to dig through the data. But it is a dangerous set-and-forget trap for a passive investor who lacks the tools to monitor corporate governance risks. Germany represents the ultimate contrarian deep value play. Compared to its global peers, the market is currently trading at a steep, almost punishing discount. The bullish case rests on the country's B2B hidden champions. Germany possesses the highest automation potential in Europe, driven by mid-size companies integrating industrial AI. The fatal flaw lies in how you buy it. The flagship DAX index is heavily overweight in legacy automotive and chemical companies. These are massive 20th century institutions now facing existential threats from fierce Chinese competition and permanently higher energy costs. Adding to that drag is a suffocating layer of bureaucracy. This administrative overhead drains corporate efficiency and prevents these legacy giants from pivoting quickly enough to survive the transition. Buying the broad DAX means tying your capital to Germany's past. To capture its future, you have to surgically isolate those nimble B2B tech leaders from the heavy anchor of the legacy automotive sector. Managing cluster risk effectively means aligning your appetite for effort with the specific structural reality of your target market. If you are a passive yield hunter, your target is Switzerland. But the rule is strict. You must either use capped weight ETFs to balance the index or consciously accept that heavy pharmaceutical concentration in exchange for dividend stability. For the contrarian value investor, Germany offers the deepest discount. The execution rule here is to avoid the standard DAX entirely. You have to use specialized all-cap funds or actively pick the hidden champions yourself. The high-capacity optimizer belongs in Japan. You must treat this exclusively as a satellite portfolio position, requiring premium research tools to hunt down undercovered robotics tech. The objectively best non-US market does not exist in a vacuum. A market only becomes the right choice when its specific structural friction matches your personal capacity to manage the trade.